Good morning, everyone, and welcome. My name is Una Protic. I'm Senior Director in Heinz Real Estate Investment, and I'm delighted to be joined by 4 industry leaders here on the stage who are collectively deploying billions across different real asset classes, and they will hopefully bring different perspectives. So together we will try to explore where the private equity conviction sits and the drivers shaping the capital flow across real assets. I maybe leave floor to you to quickly introduce yourself.
Yeah, morning. I'm Sara Sulaiman. I'm a managing director at Macquarie Asset Management. I sit in the diversified utilities team, so I acquire and sit on the boards of businesses in the utilities, energy, midstream, and transport space. I'm sure Macquarie is a familiar name in this room, but Macquarie Asset Management is the largest infrastructure manager in the world by AUM. So we have approximately $250 billion invested in infrastructure assets across 33 countries, across utilities, regulated, unregulated, transport, digital mobility, and increasingly circular economy and social care as well.
Hi, good morning. It's James Jacobs here. I'm a managing director at Lazard. I'm global head of our real assets business within private capital advisory. And I've been at Lazard now for 19 years. I helped establish the real estate practice, and about 6 years ago we rebranded from a real estate team to a real assets team. So we do both real estate and infrastructure, advising sponsors on raising primary capital, as well as advising sponsors and limited partners on various liquidity solutions and continuation vehicles and secondary transactions.
Hi all, my name is Constantinos. I'm Senior Managing Director at Capital Dynamics. I've been with the firm for 14 years. And I recently moved to Madrid to lead the office there. We are a $15 billion private equity and infrastructure asset manager. On the infrastructure side, we are one of the larger energy transition managers in Europe with 2.2 gigawatts under management, and we have 4 billion plus in AUM within that space.
Good morning, my name's Ed Jackson. I'm head of UK for the real estate platform at Pictet. Pictet is a 220-year-old wealth manager, Geneva-based private partnership with just under $1 trillion, which is now the buzzword of the moment, clearly. $1 trillion of assets under management and custody. We launched a direct real estate platform around about 7 years ago called Elevation, of which I'm part of. And we've deployed a couple of billion of gross asset value across the UK and Europe. Thank you.
Thank you, everyone. Last few years have tested almost every assumptions investor had on the real assets. We moved from a world of abundant liquidity and near to zero interest rates to the one with a bit more uncertainty, definitely on a geopolitical level, but also higher cost of capital, changing occupiers' demand, and as a consequence, significant repricing. Yet, capital hasn't really disappeared. What we are seeing instead is investors being way more selective and conviction-driven, but still very much present. So maybe I would like to start the panel with just unpacking the real asset as an asset class. Over the past decade, we've seen the boundaries between real estate and infra becoming less distinct. Maybe one for you, James, to start with. What's driving this, and how is it changing the way investors think about real assets? We did touch base briefly in the room previously, but it would be interesting to hear your perspective.
Sure. So we started off 20 years ago as a real estate team, and probably 5-6 years ago, we started the journey to rebrand and become a real assets team. It enabled us to look at infrastructure. So we look at the markets through both lenses, both through a real estate lens and a infrastructure lens. And we talk about convergence, and we've been talking about convergence for 5-6 years. And in many ways, the markets are converging. You're looking at infrastructure dollars moving into what we would consider fairly traditional run-of-the-mill real estate. We're seeing LPs collapse their teams and kind of combine their real estate team and infrastructure team to a real asset team. We're seeing sponsors in the real estate business launch infrastructure product and vice versa. So there's clearly convergence going on, but from a capital formation perspective, you could look at the last 3 to 4 years as being divergent. And when you look at institutional allocations to the asset class, most of the real estate, most of the top 150 largest institutions globally are at or above target allocation to real estate, whereas those same institutions are below target in infrastructure. So that's diverging. When it comes to capital formation, infrastructure last year had a record year. Real estate remained pretty anemic in terms of new capital formation. And actually the last 2 years, infrastructure capital formation into infrastructure funds overtook real estate, which is the first time that's ever happened. So we could say the market's diverging. And then lastly, when it comes to performance, if you look back 15 years, average real estate returns are 9%, average infrastructure returns are roughly 9%. But you look at the last 3 years, average real estate returns have been pretty much 0, average infrastructure returns about 7. So once again, you see divergence. So we talk about convergence, but the statistics, the numbers would lead us to believe maybe it's not converging as much as we would think.
Interesting perspective. Maybe Constantinos also, same question to you.
I would definitely agree with James on the convergence, divergence across LPs, or definitely seen some of the teams become more real asset focused instead of siloed within real estate or infrastructure on the capital formation side. I think for us on the energy side, we do work with real estate owners, either landowners or in the broader clean energy sector. For those that do rooftop installations, there is some convergence potentially there, but we haven't gotten to the point where the energy production owns the building yet. I haven't really seen any deals of that sort. So I would say for us, it still remains quite separate. But I think we also operate very much on the greenfield side of the spectrum, and our cash flows tend to be on the really, really long term, which in some parts, I guess, of the real estate market might be available, but in the 10, 15 years of contracted revenues is kind of a bit of a kind of special little niche part of the market.
I mean, we were chatting this morning on this, and I think part of the convergence, certainly from an infrastructure standpoint, is back to this point that you said around capital being more selective. So, increasingly, infrastructure capital is drawn to opportunities that are driven by fundamentals, and really thinking about an asset as an infrastructure asset is an asset that really has protected cash flows. And sometimes, increasingly, what we're finding is actually the barrier to entry can often be the access to the real estate. So, there's that. There's also, if I give an example, I think something like a port or access to, storage facilities, liquid bulk storage facilities in Rotterdam, which is always going to be a big import terminal. The ability to have that land and be able to build out your assets and put more capital to work is something that infrastructure investors love. I would also say that as GPs have been thinking more and more about how they differentiate themselves, the ability to build stuff on time and on budget, often quite complex infrastructure, whether they are kind of gas processing facilities or tanks or whatever it may be, is something that I think some GPs are leveraging and saying, actually, for example, we're invested in hospitals, and, part of the big play is, well, actually, if you own the hospital, if you have access to the land, then expansion becomes something that you can very much back as an infrastructure investor. So I think this is where we're seeing some of the convergence in the two asset classes and where it comes from.
Thank you very much. It's a interesting perspective and good intro into my next question. Obviously, the real assets is bringing different perspectives, some sort of security on the cash flow. It's something that it's tangible, you can see it, you can easily understand it more easily. But maybe one for Edward. How do you see the importance of real assets in the portfolios today? Obviously, you can bring maybe the real estate perspective.
Yeah, I think it performs a vital function in terms of correlating in a wider portfolio. There's no question that direct real estate is not correlated to the wider market. You look at the S&P performance over the last couple of years. James pointed out the 0% growth of real estate from probably the late 90s to the mid 2010s. Some real estate asset classes, for example, residential, was seeing 8 to 10% capital value appreciation per year. So you own a house in London, it would double in value every decade. That was the old rule, whilst the interest rates were relatively low, in a non-correlated way to the market. Now, that's positive and negative, but I think it provides an effective diversification for those also invested in other asset classes, including the listed market. So I think that's the first point. And the second point is, I think it provides a very effective inflation hedge. And during times of strong inflation, we saw after Ukraine, Russia, really, when inflation was 9-10% in the UK, Germany, parts of Europe, high single digits. Typically, there's a rent profile that is inflation protected. In continental Europe, most leases have indexation kickers on an annual basis. In the UK, you might have a 5-year rent review where you have an open market rent review. There's a further point in residential. There's a very strong correlation between wage growth and residential rental income growth. You'll see it's almost perfectly correlated. So in times of high inflation, it's a way to protect the strength and quality of your income as well. So I think those are probably the two fundamental parts where real estate plays an important role in a diversified portfolio.
Thanks. Maybe moving on to capital and allocation and what you see in your segments today. Obviously, we talked a lot about geopolitics and how it's reshaping the capital flow as of today. But James, has it become like a permanent component of investment decision making? What do you see nowadays shaping the capital allocation?
Yeah, look, as I said, if you look at the top 150 institutions globally, they are at the target allocation to real estate, which is roughly 11%. And that target is pretty static. If anything, it's probably nudging down a little bit as capital gets displaced from real estate to other yielding asset classes, infrastructure, private debt. So for an investor to commit dollars to new real estate projects or new real estate funds or what have you, they need to get capital back. They need distributions, they need realizations. And the direct property market is, relatively speaking, illiquid today. Transaction volumes are at all-time lows. They're recovering, and I think they will continue to recover, but there's been little realizations and little distribution. So there's been little new capital formation when it comes to real estate. The capital formation that there has been has really focused on two areas of the market. The mega funds have achieved like a greater share of the capital that's been formed. So actually the top 10 largest real estate funds last year accounted for 45% of the capital formation. So the market's never been more concentrated. The market's also never been more crowded and competitive. So the other half of the market is really fighting hard for capital. And I would say that the winners are either the mega funds, clearly, but also there's a thriving market for specialists. country specialists and or sector specialists. They tend to be partner-owned, independent, niche, boutique players that are really driving and performing and providing alpha.
Thanks. What about the energy sector, Constantinos? Is it something similar to what James was saying?
Yeah, definitely. I think if we look back to the last year since COVID until now, I would say you probably get dizzy from how perceptions have gone up and down with energy prices also completely changing with the various, well, COVID, Ukraine war, supply chain disruption, now this current war. So there's definitely, I would say, on the capital formation side, very big changes in terms of how high up in the priority do you sit. Our investment thesis in the past few years has been that Europe needs more independence of its electricity production, and that is in high interest and demand at the moment. Kind of 2 years ago probably was kind of lost a bit his attention, and people are remembering it again. But in general, there is high conviction around this theme, and we're riding this tailwind. There is a lot of misconceptions around energy and energy prices. I would say that the war has kind of been a net beneficial overall, but it's not necessarily that energy prices shoot up and that you don't think of the cost basis as well. So we are cautiously optimistic, but I think that for Europe, hopefully things will get better.
Thanks. And one thing also that we shouldn't be definitely skipping when we talk about capital allocations and investment decision making is the higher interest rate environment, and how is this shaping the investment case for real asset. Obviously, following the geopolitical situations with Ukraine in 2022, we were experiencing higher interest rate, but then it felt like, at least in real estate, that last year was kind of more on a positive side. Well, now I think it's still becoming, again, a hot topic. What is your view on that, Sara?
So, I mean, I would say some of the volatility in rates and inflation has actually only proved the thesis around the infrastructure asset class. So if you think back to the rate hikes were in response to inflation, and the infrastructure asset class provides a lot of inflation protection. And I think the class sort of really proved itself in that time. At the time I was sort of presiding over a portfolio that was actually net benefiting from inflation. So that was kind of quite helpful. I would say the other thing is that the kind of approach to sort of debt financing, again, distinguishing managers who take sort of a lower risk approach, the hedging that we had put in place in order to put, some quite heavy capital structures, right? Because the cash flows can support those capital structures. But, our sort of long weighted average sort of life of debt, putting in place longer term debt, hedging, really made sort of certain managers stand out and certain portfolios stand out. I'd say since then, the high interest rate environment obviously is kind of driving demand for higher returns. And so this comes back to the point of selective capital and really thinking about not just where to deploy the capital and get the AUM, but actually how you create alpha out of your investments. So protecting on the downside, but also I think we're finding that our LPs are demanding higher returns for the same asset classes that we were. You're slowly seeing it impact valuations in the market and what assets are actually transacting at as well.
No, I agree, and I think it's probably something similar on the real estate front in terms of capital being more selective, and how is this also shaped by the higher interest rate environment?
Yeah, I think higher interest rates is a fundamental part of the real estate play. It's an industry that typically has quite high leverage. Senior debt can stretch up to 65% normally, and in times of increased interest rates, there's a multiple negative effect. First of all, valuations typically decrease because there's that natural spread between where the interest rate is and the risk-free rate, and property yields as well. So typically you have a 100 to 200 basis point spread between yields. And as yields widen, multiples decrease and valuations go down. So it affects your capital structure in that manner. But secondly, in developments and opportunities where you're looking to deploy CapEx and you're looking to finance your cost of debt going up, it decreases your net operating income, it increases your development cost, your CapEx requirements, so it impacts viability of developments. So typically you find in times of higher interest rates, everything else being equal, developments will go down in terms of viability of projects that can be built out. So it has multiple strands of effects, I would say, and the overall impact is that it subdues investment volumes, it decreases valuations, and it has sort of a negative impact. What it does do, however, though, especially, we talk about this correlation point a few minutes ago, at a time when S&P is trading at very high multiples, real estate is actually trading at very wide yields, which means very low multiples. And actually, it's a very interesting entry point. It's a very interesting basis and time to get into the real estate sector. So I think if you're looking to make a market bet and create beta as well as alpha on top of it, there's certainly a beta play going into the cycle because we're in that trough period right now, which is indirectly as a result of higher interest rates.
So maybe one follow-up for you. In the world of higher financing costs and more selective capital, what are the characteristics that would make assets a good deal, a good investment today?
Well, you have to always in real estate go to the fundamentals. And I think it's important, first of all, to take a top-down approach, a macro-driven approach. In other words, what are the macro thematics that are shaping the built environment, whether that's people buying online, wanting same-day delivery, therefore putting pressure on infrastructure and logistics, or is it that people have an affordability issue with buying new properties? So house ownership is decreasing because of wage growth hasn't kept up with property appreciation, but also mortgage rates are high and there's limited supply. So is there a pivot to multifamily residential, for example, more people renting for longer? So we sort of take a top-down approach, and then once we've accepted the asset classes that we like, so in this case we've mentioned logistics, the same can be held true for data centers and also residential, then it's vitally important that you take the locality. You really have to kick the tires or kick the bricks of a building and understand all the local aspects. So look at local transportation. Do people want to live there? You see that Oxford Street, for example, is having a bit of a revival. Part of that is because of the new Crossrail that's come in, and there's pedestrianisation as well into Oxford Street. So as an example, you wouldn't necessarily take a macro without taking the micro as well. So I think you take a high-level view, but then very, very specific. There need to be very competent demand and supply dynamics, and then very interesting characteristics at the very street level, at the micro location level as well.
Which goes back to also like having the right skill set to assess this micro level in the right way. What about the infrastructure perspective on that one, Sara?
I mean, I think it's interesting. As I was listening to you, I was thinking it's the same for infrastructure, right? It's all about the fundamentals. I think we have learned, certainly backing regulated utilities, regulatory risk is always mispriced, is my view. And I think certainly what we've seen over the last sort of 5-10 years is a lot of regulation, even though on the face of it, it's independent, is actually very much sort of impacted by the political winds that are blowing at the time. And so really thinking through, in the investment horizon of an infrastructure asset, you're thinking 10, 20 years, what is really the through cycle performance going to be in spite of the temporary sort of political sort of winds that are blowing? And that comes back to the supply demand fundamentals. I think for us, what is really attractive is the need for investment. So the ability to deploy follow-on capital in a market where there is a supply-demand imbalance or where there is a sort of a strategic reason why, that sort of investment is needed, investment in water infrastructure in places that are deprived of water, for example, or that suffer kind of, dry spells, etc. And really back to my point that I made earlier, combining the supply-demand fundamentals, the macro, the thematic, with businesses that really have very much embedded barriers to entry there. So thinking, and whether those barriers to entry can be capital that's already been invested that nobody's going to replicate. It can be access to real estate. It can be, frankly, the contractual structure that they have with customers that last kind of 10, 15 years. It can be their ability to renew customers at a really high rate. So depending on where you sit in the risk spectrum, a good investment sort of, looks a little bit differently. But I think ultimately it's about the resilience of the long-term cash flows and your ability to be able to deploy more capital and use your sort of own strengths as a GP to kind of create alpha through that investment.
And I come at it from a slightly different perspective, in terms of, we're really trying to underwrite people and underwrite management teams. And I think when investors historically, maybe back in the day, looked at real estate and looked at infrastructure, they viewed it as more of a kind of long-term income generating, passive, coupon clipping type play. And I would say over the last decade, it's certainly changed to become much more operational. These assets are not passive assets that just generate a yield. You actually need management. You need operating expertise. That helps you with growth, but it also helps you de-risk your cash flow. So we're trying to back management teams. And, yes, we have a view on the macro. Yes, we have a view on the markets and the sectors that we like, and we have a bias towards certain things. But I fundamentally believe that if you've got the right management team and you're backing the right investment professionals, they can almost make money in any market, in any sector, as long as it's not about to fall off a cliff. So we're really out there searching for management teams to back.
I'd say, it's a really interesting comment. So my background sort of originally before moving into infrastructure is in private equity. And I find it's not just about finding the right management team. I think it's about aligning incentives as well. And I think this is one of the challenges actually we have in this sector, because we're such long-term investors, and often kind of the hold periods of our assets and the time that we expect them to deliver the returns actually outlives how long you can properly incentivize management for, right? So in private equity, there's generations of management teams who have been incentivized to deliver kind of returns within, it used to be 3 to 5, maybe nowadays it's 5 to 7. And that's a conceivable period of time where you can construct a very simple incentive structure. You make money, I make money, the money gets crystallized on exit. But I think as I've moved to infrastructure and thinking about the way infrastructure delivers returns to investors, and thinking about whether it's cash yield period on period, whether it's the long-term kind of 10, 15 years, sort of what is the right construct that aligns sort of, what you need management to deliver with what you need delivered for your investors, and aligning incentives that way. Because no one's going to, if you say to management, you're not going to get paid out for another 15 years, then I think that sort of defeats the purpose of the incentive. So it's a really interesting space, I think, within infrastructure investing.
Yeah, I think it's a very good point about people, at least on the real estate side. What I've noticed, like in the uncertain times when you have really trouble-making business plans to manage and the environment is changing quite quickly, you really need to have a very agile, hands-on team who is managing the project. Otherwise, they can bring some new perspective and eventually recover the returns or find a way out more easily. Well, unless you are like, you have some other teams that are maybe more hands off, but definitely people really matters, at least in real estate. Maybe on the flip side, what types of real assets are struggling to attract capital today? Sara?
Yeah, so I think a lot of the mood around the space now has been colored a little bit by how frothy the market was kind of back in 21, 22. And, in the infrastructure space, a lot of really big assets came to the market, a lot of very hotly contested auctions. And I think it came to the point of again, mispricing the risk, right? So I think there was a bit too much leverage available. People took it, a bit too many sort of high prices paid. And certainly there was a flight of capital towards, emerging asset classes or asset classes where people mispriced a little bit the risk. So we've talked about energy transition. A lot of capital went towards energy transition. A lot of these investments were actually investments that took on an inordinate amount of development risk, construction risk, regulatory risk, political risk, and they didn't sort of pan out the way that people thought, backing sort of a massive EV rollout and then realizing that actually that doesn't play out within the timeline. So I think it's a lot more cautious. So I think that's one area where I think, investing in green for the sake of investing in green is no longer the case. And I think people are thinking a lot more about a more managed transition. A similar allegory is really fiber, and we talked about digital. A lot of investments into speculative fiber rollouts, but that's where the barrier to entry argument really played out because it actually became a very competitive market at the end of it.
We will go back to sustainability point in a second. What would you say in terms of real estate? What is like an absolute no nowadays?
It's a good question. I'd like to answer that in two ways. First of all, historically, if you could imagine institutional investors passively investing into real estate, the majority of assets would be offices and shopping centers. It was almost 75% of real estate portfolios. And as those became less attractive after work from home and COVID policies, I know that's being reversed now, but if you think about the last few years, and shopping centers valuations fell off a cliff. I was on a panel a couple of years ago where you had a bunch of pension funds and sovereign wealth funds all trying to fight about how quickly they could de-lever their office exposure. And some were going from 60 to 40, and these were tens of billions of funds. So the office sector and retail was an uninvestable asset class for quite a period of time. I think that's slightly reversing now, and this is to the second part of the argument, or the way to answer. I think investors are now being very, very discerning in terms of where they're investing. I think offices in certain core markets, in very good quality core locations and good buildings with good covenants are very attractive in terms of investments. But if there's any kind of imperfection on the asset or the location, then investors will be very risk off. And this is why you talk about this K-shaped recovery. In other words, one that has a positive and a negative aspect to it. And I think core offices remain attractive, but regional offices or offices in need of significant capex or refurbishment are uninvestable at the moment. I think a couple of other asset classes, others are looking at sort of secondary industrial logistics estates where there's still some repricing going on, and vendors and buyers still don't have that appreciation of where the true value is, and you've got a very wide bid-ask spread. And then very particularly in my home turf, I think if you look at, for example, the high-end residential asset class, prime London resi, this is an asset class that's been declining or going sideways almost for a decade now, through a whole bunch of different policy regulations and changes to non-dom status, and also stamp duty was the main trigger. So I think there are certain aspects where there's too much supply, a lot of overvaluation, so I'd be very reluctant to invest in that asset class as well.
Thank you. Sara, you briefly mentioned sustainability, and it has been an important driver, let's say, of the investment decision making in the past 5 years, but how did the focus shift, and has it actually shifted back primarily to the returns? How important is still sustainability in terms of investment decision making?
Look, it's very important, and it always will be very important, because I think when you're investing for the time periods that we're investing in, you need to protect your cash flows, right? And therefore, you need to manage downside risk, and sustainability is a really important way to do that. I'd say, there's been a shift in the last few years. Like I said, I think a lot more of a recognition and a reality check in the market that sustainability needs to give you comfort that there is a right transition happening over the period of time that you own the asset, as opposed to assets will have fully transitioned kind of today. And I'm talking about sort of green transition today. And some investments ride on the transition thesis. Other investments just need to make sure that actually sustainability is there as a hygiene factor from a governance standpoint, that you're putting the right capital to work to make sure that you're achieving your longer term goals. So I think there's a lot more of a recognition there. I think we've all adjusted to the banks and the lending criteria and thinking about sustainability to basically access that capital. So that's going to be quite important as we go. But I think the other thing is that we're beginning to think a little bit differently about assets that don't have that green sort of edge. So I look at energy investments and thinking about, as a closed-ended fund, will you actually be able to exit an asset? And what are your exit assumptions around an asset that has primarily, for example, hydrocarbon exposure? The availability of debt financing for those types of assets has gone down, and so there's been a bit of a valuation shift there.
And we're starting to see investors think about climate as well. And there are certain markets globally, if you take Miami, for example, where there's a debate within the real estate world as to whether that market is a sustainable market going forward, given climate. And at the moment, you can get insurance. But as soon as you can't get insurance, then the question is it an institutional market? Do institutional capital want to be there if you can't insure against climate risk? So that's also on investors' minds.
I would say it's very important. For us, maybe I would break it down in kind of 3 parts. On the investment side, it's very important. There is like the risk element of it, where you look at all the potential things that can go wrong if the investment is not sustainable. Every project we have has an allocation of capital that goes to local communities, so we work closer with them. There is this element of divergence where we see some landowners where they want to combine some kind of sustainable agriculture where possible alongside the assets. We look at all kinds of geological metrics on flooding risk and whatnot. So I think there's no change there. I think a good asset is also more sellable afterwards if it's well done. I think on the LP side, that's where I have noticed quite a big change in the last few years, and the spectrum has widened quite a bit. I would say in Europe, it still remains relatively focused on this. In other parts of the world, we have new entrants to where there's investors that really care about it now, where they didn't before. And then there's others that hate it to the point where they don't want to hear the word sustainability, because it raises so much negative alert on greenwashing and whatnot. So I think navigating through that is something new, and I think rightfully so. We don't really fly the green flag. I think for us, it's naturally what we do is just for packaging the investment to be better at exit. And then I would say the third element, which affects our day-to-day, is a lot of the reporting that we have to do. And I think that the regulators, it would help if they agreed on one set of criteria, because then it affects how you report on these metrics versus reporting on multiple regulatory measurements.
Actually, you raise a good point, Constantinos, and I think it's important in the real estate world as well. I think I don't look at it as a box ticking exercise, and I think there is this risk of greenwashing. I think for real estate, where it makes commercial sense to be environmentally sensitive, then that's what you should do. And I think there's probably 3 ways in which that can manifest itself. The first is if you improve a building's performance by improving the operational side of things, changing halogen light bulbs to LED, putting double glazing windows, or putting reverse heat pumps, or having lights that only come on when there's a sensor in the room. All of these measures make perfect commercial sense. And those are good ESG measures, and they decrease your utility costs and the building running costs. The second part that's related is if a tenant's costs decrease, then actually as a landlord you can afford to charge them a little bit more rent because they'll be less sensitive to rental increases. They'll feel like they're getting a better overall environment and they'll be happier to pay higher rent. So for a landlord it actually makes sense on that side as well. And the final side is on the exit liquidity. Typically, if you have better certifications, it's a bit of a badge of honor. You attract better, higher quality investors on the other side, whether it might be a pension fund or a sovereign wealth fund. And therefore, you can probably extract a little bit more value on the cap rate that you're selling the building for at exit. So for me, I look at it purely commercially. I think it's great that there are added on benefits and we're all doing good for the world. But I wouldn't sort of use it as a strategy. Otherwise, you can sort of trip up over your own tail if it's the main leader, and then it'll be the tail wagging the dog. And I think if it makes commercial sense, then absolutely we go for it.
Yeah, I mean, I think investors into real estate, investors into infrastructure are investing in the asset class because they want predictable cash flows. And those cash flows need to be sustainable. The assets that you acquire need to provide that cash flow year after year. So I think when we talk about ESG and sustainability and climate, it's just, I guess, one of the number of factors you have to think about when it's sustainability of the cash flow.
And that's a very good point. And given that we are almost near to an end, maybe James, one for you. We talked about capital allocation, we talked about investment teams, and what is truly a good deal in the real assets today. What does the LP-GP alignment truly means in today's market? Like, how do you see it?
Well, I think to Sarah's point earlier, it's a key question because with these longer duration funds and longer duration assets, getting that alignment right for management teams to ultimately get remunerated during the hold period or during the length of the business plan and duration of the business plan is pretty important. There's textbook answers about alignment of interests. It's about the sponsor putting in some capital. Is it meaningful? It's about kind of incentives and performance fees and so on and so forth. Personally, a bit of a I think that investors spend too much time, and my peers on the panel may disagree with me, but I think investors spend too much time thinking about the actual structure itself and too little time getting to know the people they invest with. And I fundamentally believe if you invest with good people, the right people, honest, hardworking, trustworthy people who want to do the right thing, come what may, you'll get a better outcome. And if you invest with the wrong people, you're going to get into problems. So I think investors spend too little time really diligencing and understanding who they're investing with. They spend more time actually on the structure, which the structure is important, but it amazes me the disproportionate amount of time spent on talking about and negotiating a structure versus actually spending time getting to know your counterparty.
We have, James, just to your point, we have a sort of internal team dynamic of every deal that we do, we look at three things. It has to be the right building at the right price with the right team. And we always say, if one thing could go wrong, what would you be fine with? And we always go back to the fact that if you've got the right team and the right people, you can sort of save yourself out of anything else. Whereas, if you're with the wrong partner and you've got the right building, it might even be at the right price, it can actually turn out to be a very, very bad experience. So I totally agree with that adage. I think, backing the right team is fundamental.
Thank you. Maybe one last quick fire round for you, Sara. What's one investment team you have higher conviction in today than you did a year ago?
I would say the nearshoring of certain industries back into Europe.
Constantinos, what will separate the winning strategy from the rest in this cycle?
Definitely operational integration within the team to be very hands-on at the asset level.
Maybe add the same one for you.
I'd like to answer the same question that Sara was on, which was what I feel more strongly about this year than last year. I would say Oxford Street retail. I think it's got a very big rebound story because of Crossrail and pedestrianisation. I think West End offices are coming back. Low supply, very high demand. People are coming back to work. And I like luxury branded residential, but not in London. I think there's too much supply. I think in continental Europe, particularly Madrid, Milan, Rome, Paris, in these markets, I think that's a very good investment play. That's what I would say for that. Thank you.
James, same question to you.
Well, picking one.
Picking one
theme.
of the two for the end.
I mean, I'm going to opt out and go back to my earlier point that it's all about people. So, we just, we have an open door policy. We meet lots of managers. We don't have a fundamental view on really where to deploy capital. But when we find a team that has a long track record, an investment thesis that makes sense, and they're passionate about what they do, we get excited.
Thank you very much, all. I think we are running out of time here. Well, I would just like to wrap it up. Obviously, we covered a lot of ground here, and I hope you all enjoyed the discussion. But definitely to conclude, what has really changed in terms of capital flows is the level of selectiveness. Investors are still being here and very much present, but equally very disciplined and thematic, which also I think means that in times of uncertainty, you can actually find very compelling investment opportunities, provided that you have the right skill set, conviction, and I would say patience as well. So please join me in thanking our panelists for sharing their insights and perspective today, and I wish you a nice and successful day on today's conference. Thank you.